What if I told you that the last e-commerce business that we onboarded as a new client, we saved them over $1 million in tax and grants within a 2-month period? We didn't increase their revenue. We didn't go through and try and do anything that was illegal or too far outside the square. What we did was actually just review the prior advice that they had been given, review the tax that they had lodged, and look for any potential opportunities that would allow them to create a better tax situation overall. Today, I'm going to go through an e-commerce business case study so that we can give you an indication of, I guess, one, what you could be doing and whether you're missing out on tax. Now, this is an e-commerce business. However, it's similar to most businesses out there. Basically, anyone that's scaling quite quickly, has significant amount of revenue, selling, whether it's a service or product here in Australia or even overseas. Listen up if you want to listen to how we save this client a fair chunk of cash. I'm going to break it down first. This individual came to us and they want us to review their tax and obtain a new accountant. Why? Probably a lack of confidence and clarity in the prior accountant, not fully confident in the outcome of their tax position, and not knowing or not getting any proactive advice of whether they should be changing things or restructuring or doing more than just running their business. So they came to us as a sole trader. And for those that are in the e-commerce space, it's very, very common to see an e-commerce business scale very, very quickly. Now, in this case, this business, it only took them a couple of years to go from zero to mid $4 to $5 million or mid $4 million in revenue, and on paper, very, very successful. So basically, running this online retail store, $4.5 million in revenue, they were probably profiting roughly in the low $1 million. So they had a fairly healthy margin of 20 to 25%. The problem was that they're growing so quickly that there hadn't been any advice or any structuring or proactive forecasting to make sure that they're retaining as much of that profitability as possible. And so first and foremost, what we did was look at their structure. And so they were operating as a sole trader. Now, sole traders are fine if you are running a very small business, let's say your lawn mowing business, and it's just you and there isn't much risk and you're not looking to grow and scale or take over the world. The sole trader structure has many advantages in terms of costs. It's very cheap to run, low barriers of entry, but it's not great in terms of tax minimization and it's not great in terms of scalability of a business. Ideally, this business, because they also need to do some research and development, which they aren't able to do in a sole trader, ideally, the entity that they should have been running through is a company. Because it's already been 2 years down the track and because they hadn't sought any advice prior, the problem now is how do we restructure this sole trader business from this existing structure to a company? Now, most people will just say, well, can't you just set up a company and we'll just switch it over? No. So basically, upon review, if the ATO came and had a look at your figures and said, hey, there's actually a value here that you're transitioning from one entity to another and it's a deemed sale, then there's potentially capital gains tax. In this scenario, that's exactly what was going to happen. If we were to restructure a company, the business was circa valued around $4 million, the tax consequence around that would have been very, very significant in the realms of $500,000 to call it $800K, depending on the finalized valuation in terms of capital gains tax. And being that business was held and owned by themselves personally as a sole trader, you're looking at tax at upwards of 47%, even after utilizing small business concessions and discounts and all those sort of things, right? And so let's just call it $500,000 that they were potentially going to look at. What we wanted to do is just see if we could utilize any strategic and available legislation at the minute to be able to either minimize that as much as possible or potentially freeze or wipe it altogether. And so we went and transitioned them into a company structure and used a small business restructure rollover relief. We went through all of the considerations in terms of capital gains tax. So we went and had a look at, well, what would be the outcome if we were to utilize or go down the capital gains tax path using discounts, exemptions, all those sort of great incentives that the ATO are allowing you to do. So we ended up going through a small business rollover restructure. We obtained valuations for third-party valuations for the business itself. And then in the end, it turns out that we were able to save them from from paying any tax at all in terms of the restructure. So immediately within that 2-month period, we were able to give advice and help implement them a new structure that would save them circa $500,000. Over and above that, we then reviewed the past 2 years of their financial statements. The ATO as a small business allows you to review tax returns within 2 years of the lodgement date or when the client receives, let's say, personally notice assessments. And so we reviewed the last 2 years and we found a concerning amount of issues that luckily enough we were able to go back and reverse. However, it does pose the risk of alerting the ATO maybe that there have been changes made, and so we just have to make sure that we have the right evidence and documentation as to why we're doing that. And in this case here, very, very common as well, e-commerce businesses that haven't sought out advice or do not have an e-commerce accountant, they conduct a lot of business overseas. They sell a lot of product to the US, to the UK, and in this situation, a lot of product was going to the UK. And we had found that the way that the BASs were prepared and the review was done, that they were actually paying GST on all of their sales to a lot of countries overseas. And over a 2-year period, we were able to figure out that there was north of $120,000 of overpaid GST. So it pays very much to have an accountant that will do a deeper review. Yes, you may pay a little bit more in terms of the preparation of the actual fee, but in this case here, if this client would have spent time, they would have had that extra $120,000 in their pocket a long time ago. Yes, they've got it back. If they never came to us or didn't switch accountants, would they ever have got it back? I don't think so. And so this was another win. So we're now up to, call it $620,000. We were then able to have a look at their tax consequences as well. Have they lodged their tax returns in a way that they were able to utilize as many deductions and opportunities that were currently available at the time? And we reviewed this, and over the last 2 years, there was also another significant amount of tax that they have overpaid. And so very, very quickly, it starts adding up. So we've gone through fix the structure, save them tax, review the GST, save them tax. Actually, over and above that, just thinking about it as well, we also went through all of their invoices where they were importing items from China to sell. That's where they manufactured their products, and they had not claimed back the GST on the duties and transporting the actual products to Australia. Very, very common outcome, because when you are doing self-bookkeeping or someone doesn't, again, understand the importing side or the e-commerce side, is that you have to basically put in that GST manually. So that was north of $50,000 that we were able to get back as well. Over and above that, the client was now in a structure where they were able to look at grants or future grants in terms of R&D. So that's going to be a future tax saving there or opportunity to get back some credits. But immediately, whilst this was happening, we referred them to the specialists around export marketing grants, where they were able to receive over $150,000 per year in terms of funding. They did significant amounts of Meta ads and TikTok ads overseas, which means they were eligible to actually access free government grant money in terms of their spending. So they were spending a lot of money in ads, and the government actually paid back more than 50%, up to 50%, up to $150,000 each year of your marketing spend or for his marketing spend. And so overall saved them a significant amount of money. Yes, it took us time. Yes, it took the client a bit of an understanding of why it was all happening and how the restructure works. However, to save that much money in a short amount of period, it really opens your eyes to whether or making the most out of your accountant and making the most out of your strategic advisors. So for those that have a business, whether it's e-commerce or any type of business that you're running at a high level, it's worthwhile having a review. If you do need help, feel free to reach out. Happy to get the team or myself to review your work, and hopefully we can save you some tax. You have a bit of peace of mind going forward and a bit of clarity and confidence that you can scale your business further without actually have to paying the tax man more than you should.